Hello everyone and welcome back to the channel. Hope you guys are doing really great. So as we continue discussing the Q4 FY26 and the full year FY26 result. So in my today's video, I'm going to discuss to you about electronic manufacturing services company called as Syrma SGS Technology, right? So they are into this contract manufacturing for for various sectors, for various business. So the main business is B2B, and what they do as per their requirement, they design and manufacture this electronic thing, circuit boards and other stuffs, and then they give it to the company. So that's what their whole business model in short. So we'll right now go into their results and go through their con call summary and see what are they doing and what is changing in the business that is driving improvement in the margins and things are improving for the business. So let's get into it. So if you look at their Q4 FY26 result, the revenue grew by almost close to 58% to 1,465 crores, and PAT was up by almost 46% to 119 crores. And if you look for the whole year of FY26, the revenue increased by almost 27.26% to 4,819 crores, and PAT was up by almost 102% to 346 crores. So, and if you look at their margins, right, they both improved. So the EBITDA margin improved to 12, and the PAT margin improved to 7.1%. And the other thing what the management said, right? So generally in their business, the second part of the year is much more uh, beneficial than the first part. And if you look at their revenue bifurcation, right? So 75% of the revenue comes from India, and their export revenue is almost close to around 25%. And the other good thing, what they said is like the export revenue grew by almost 21% YOY. And if you look at we'll go through their segment, right? Because they cater to various kinds of industries from auto, consumer, healthcare, industries, industrials, IT, and railways, and they're getting into defense also. So what we'll do, right? We'll go through their revenue contribution overall and what is the growth compared to last year. So if you look at auto, right, it contributes to almost 24 contributed to almost 24% of the revenue for the whole year, which is around 1,139 crore. And if you look at the growth rate, it grew by almost 39% YOY to 39% YOY. And if you look at their consumer division, right, it grew by only 8% and contributed around 30% of the revenue. Over here, what the management said, right? They want to keep this consumer division revenue contribution below 35% of the overall revenue. The reason is why, because this division is a very low margin division. So they don't want to grow much into it, but they want to keep it, for the revenue and the businesses. So it grew by only 8% to around 1,452 crores. Healthcare segment grew by almost 36% to 395 crores and contributed to almost 8% of the revenue. This is the segment which they started newly, and it is doing quite well, and they are planning to increase it further also. And if you look at industrial, right, they also grew. It also grew by almost 30% to 1,398 crores contribution, which is almost 29% of the overall revenue. And if you look at the IT and railways, right, it grew by almost 74% and contributed to almost around 9% of the revenue to 433 crores. So if you look at this, all the segments, right? So the major growth segment are auto, healthcare, industrials, and IT and railways. And these are high margin um, uh, businesses, and that's where the management wants to concentrate, and they don't want they want to continue their consumer business, but they're not concentrating on it that much to grow it at that high level. So let's look at their as they're into manufacturing, so they will have multiple customers, and we look at the customer concentration, right? So if you look at their overall customer concentration, right, the top five customers contribute to around 34% of the revenue, which is quite good compared to some other businesses where the top five customer contribute to around 80 to 90% of the revenue, where even one customer's leads can have an adverse impact. So they have quite done well in that. So if you look at top 10 customers, they contribute to around 47% of the revenue, and the top 20% contribute to around 63% of the revenue. So if you look at the concentration, is quite spread. So in case if something, some customers unfortunately leave, it will not have a adverse impact. And the other thing what the management concentrated, right, is like they had targeted, you know, the what do you call the export growth to around 1,100 crores, which grew to almost 1,200 crores for this year. And they had an EBITDA target of around INR 400, which they did easily. The only thing which they couldn't achieve overall was the revenue growth because they targeted for around 30 to 35% of the growth, but they could only grow for the whole year only around 27.26%. But I think we can forgive the management for that because if you look at the overall, right, the margins have improved. The EBITDA, even though they could not achieve their overall revenue target of around minimum 30%, but they were still able to achieve the EBITDA target very easily. And the other thing, what the management said is right, the better margins are coming from the business segment, which, as I said earlier, right, which is from automotive, industrial, healthcare, export and ODM. So what is ODM? I'll explain to you. So it's original design manufacturing. So what earlier Syrma used to do is right. The customers would come, they would give their design and everything, and they will manufacture. So the margins over there were quite less. So what Syrma has transitioned into is right. They have started designing their from their own side and giving it to the customers as per their requirement, which has helped them get better margin. And as I said earlier, right, they are not concentrating much on the consumer business to grow because as it's a low margin business, but they still want to continue with it and they want to, keep the overall contribution to the revenue to less than 35%. And the other reason for, the improvement of the margin is that they reduced their debt by almost close to 50%. So they had a debt of around 611 crores at the start of the year. Now they have only around 353 crores. And if you go through all the con calls of various companies, especially if they are dependent on export or if they're importing their raw materials from outside the country, everyone is asking about the same question as about what is the impact of the geopolitical issues. So I will just list down the things which the management spoke about it and what are they. So what is the impact? What are they trying to do? And how are they trying to pass on the cost? So first of all, they said that the supply chain issue is global, right? So it is not just related to Syrma where they can lose business to other customers. The supply chain issue because of this, geopolitical issues is global. They have confirmed that the raw material prices have gone up, logistics costs have gone up. The only good thing in what they said is like it's not just Syrma is impacted, but all the companies are impacted. So you know so the overall market is aware of what is happening. It is not just like something is wrong with the business, but it's what is happening in the overall market. So what they are trying to do, right, in order to pass on this cost, they are in continuous contact with their customers, where they are trying to see how they can pass on these cost to them, with slight changes in prices. But the only thing what management said, right, they cannot pass the cost as soon as it is increases, right? So there has to be negotiating happening, and the new price has to be agreed, which takes some time. So the passing on of cost will take some time. And this will continue until the situation comes back to normal. And because of this, what the management is guiding for the EBITDA margin for the next year, they're trying to be very conservative, is around 10.5% to 11%. Even though they did 12% for FY26, but they still want to be conservative and they're guiding only for around 10.5 to 11%. So we see in terms of the growth they have it, and let's see what are they doing, right? So because if anyone is into manufacturing, right, the only way to increase the sales is obviously use the current capacity at maximum. At the same time, if the demand is there, start a new plant or manufacturing facility where the growth will come from. So what they are trying to do, right, they are setting up a new plant where they're spending around 800 crores, and this plant is specifically related to PCB related business, which is a printed circuit board. So this is divided into two phases. So in the first phases, they'll spend around 400 crores, and which will be operational by FY 28. So what they are doing is right out of this 400 crores, they have already spent 50 crores. 250 crores is going to be spent this year, and the remaining will be spent in FY28. And they expect, the commercialization and the production to start by FY28. The second phase will only start in uh, FY29. And so this is what they are doing for, for the growth of their business going forward. And they are spending so much of money at the same time because they're into manufacturing. The capex is required to manage the current business and to ensure that the our manufacturing facilities are up and running all time, right? So they are doing a capex of around 100 to 150 crores, which will be spent in the normal course of business. And especially for the 800 crores, the question was asked how the funding will be done. So the management is very clear. The funding will be done via debts, via internal accrual, as well as in this new manufacturing plant, they have a JV. So 25% of the cost will be contributed by the joint venture partner. And the other thing, what the management said that they wanted to, and they want to enter the renewable energy space, into manufacturing all these things. So what they are trying to say that they were planning to acquire this company called as K Solar, but they had certain conditions set for them. So obviously, the details of those conditions are not publicly; it was private. What the management said, right, during the negotiation, whatever happened, that the other company, which is K Solar, was not ready to fulfill those certain conditions. So the Syrma management has decided to drop off this acquisition, but they're still saying that they're still looking into to enter the renewable space. So they going forward, they will look whether they want to acquire or they want to start their own division. So we'll keep an eye on this. At the same time, they have entered into the defense business also, which is a high margin business, but quite capital intensive. So let's look at the guidance what the management has given for the growth, right? So the management is very confident, and they have said they can grow by almost their revenue for FY27 to almost 35%. And with the way things are going, and with the way the demands are already there in the market, and the new PCB plant is going to come, they are saying that they can do this 35% growth for the next 2 to 5 years. I don't know about whether they'll be able to sustain it for the 5 years, but for the next 2 years, this is definitely guaranteed. And the reason why I'm saying is right, see, because in today's market and today's situation, a lot of things change very fast. It is not like the old times of 80s and 90s or early 2000s where businesses would change slowly, or the market would change at a very slow manner. So where you can think about 5 years or 10 years down the line. But now things can change so quickly within months, within a year, right? So we need to keep that perspective in mind whenever management is guiding to see. So for the 2 years, it's definitely guaranteed 35%. If the management is able to achieve the 35% growth for the 5 years, that would be a really, really uh, great. So let's see how well they do. I'll definitely keep an eye. Personally, they are doing all the right things. They are entering into business which are improving their margin. They are, starting a new manufacturing plant which will be up and running hopefully by end of FY28. Which will fuel the future growth. So I'll definitely keep an eye on this company, and I'll definitely keep you posted on every results which come every quarter, and see whether they're able to execute what they have promised. Because see, one thing is very important, right? It's one thing in the stock market where the company comes and says, okay, we're going to do X, Y, Z. But what actually matters whether they are able to execute or not, and that's what the market looks for. Because if they're able to execute, the market will reward the company. But at the same time, if they're not, if they're able to, if they miss their production, then the market will just brutally kill the stock. So we'll keep an eye, and I'll definitely keep you guys posted. And if you like this analysis and this video, please do hit like and subscribe to my channel. Thank you, and God bless you, and see you next time.